the fascinating world of gold prices and their potential impact on the US dollar. Gold has always been a significant player in the global economy, but recent trends have sparked some intriguing questions. Is the surge in gold prices killing the US dollar? Let's break it down. First off, let's talk about India. Gold is a massive part of Indian culture and economy. Just like the American dream is to own a home, in India, the dream is to own gold. That's more gold than the central banks of the US, Germany, Italy, France, and Russia combined. For perspective, the US holds around 8,100 tons of gold, while Russia holds 2,332 tons. But Indian consumers alone hold a staggering 21,000 tons of gold. Now, in the past 6 months, if you've been watching the markets, you might have noticed something wild happening. The Indian stock market hit $5 trillion, overtaking Hong Kong. At the same time, gold prices in India reached an all-time high, soaring above 70,000 rupees. While the Sensex returned 8.33% and the Nifty 50 nearly doubled with a 99.92% return, gold prices shot up by an astonishing 16.16%. So why is this happening? One key reason is that central banks around the world are on a gold buying spree. Over the past 2 years, they've been stacking up tons of gold. For instance, India recently moved 100 tons of gold back from England. In recent years, India bought 69 tons, China bought a whopping 314 tons, Poland purchased 130 tons, Singapore grabbed 125 tons, and even the Czech Republic added 75 tons to their reserves. This global trend of gold hoarding has driven prices to unbelievable levels. So, why are central banks loading up on gold? What are the global factors at play, and should you consider investing in gold too? Back in the early 20th century, the world had already endured World War I, and by the late 1930s, World War II was in full swing. The infamous Treaty of Versailles, signed after World War I, set the stage for economic turmoil, which eventually contributed to the outbreak of World War II in 1939. The entire world united against Hitler and his regime, leading to the most devastating conflict in human history. At this time, the British Empire was a global superpower with vast colonies spread across the world. However, the economic toll of World War I and World War II had significantly weakened Britain's wealth. By the early 1940s, Britain's debt to GDP ratio had skyrocketed from 25% in 1914 to 220% in 1920, and further to 270% by 1942. Similar economic distress was seen in other major countries like France and the Soviet Union. Meanwhile, the United States played its cards wisely. Initially, the US stayed out of direct involvement in these wars, acting instead as a supplier of essential goods. America, untouched by the war's destruction, became a prosperous land of plenty. Cheap fuel and technological advancements powered a booming economy. American industry was perfectly positioned to dominate both domestic and global markets after the war. Here's where it gets interesting. While other empires were fully engaged in the war, diverting all their resources to the battlefield, the United States focused its capital and manpower on becoming a major supplier. They provided cotton, wheat, brass, rubber, automobiles, machinery, and thousands of other goods to the war-torn countries. This strategy led to one of the greatest economic booms in US history. US exports skyrocketed from $2.4 billion in 1913 to $6.2 billion in 1917. In the 1940s, the world had already experienced the devastation of World War I and was in the midst of World War II. The infamous Treaty of Versailles, which ended WW1, had set the stage for economic turmoil, eventually contributing to the outbreak of WW2 in 1939. By profiting from these costly wars, the US accumulated vast wealth. While other economies lay in ruins, the United States ended up holding 75% of the world's monetary gold. US gold reserves surged from around 2,000 tons in 1910 to nearly 20,000 tons by 1940. This unprecedented wealth set the stage for the United States to solidify its economic dominance. In 1944, the US convened a conference in Bretton Woods, New Hampshire, gathering representatives from 44 allied nations. The goal was to establish a new international financial order and promote economic cooperation post-war. This meeting resulted in the Bretton Woods Agreement. Under the Bretton Woods Agreement, these 44 countries agreed to peg their currencies to the US dollar, which was in turn pegged to gold. This arrangement meant that 1 ounce of gold was worth $35, or 28.35 grams of gold equaled $35. The US promised to redeem dollars for gold, effectively backing the dollar with gold. This gave countries confidence in holding US dollars, knowing they could exchange them for gold. So, why did these countries agree to the Bretton Woods Agreement? The main benefit was stability. By pegging their currencies to the US dollar, countries gained a reliable exchange rate system, which facilitated international trade and investment. Additionally, backing the dollar with gold provided a sense of security, as gold was universally recognized as a valuable and stable asset. This system helped the US dollar become the dominant global currency, underpinning international financial stability for decades. The Bretton Woods Agreement laid the foundation for the modern global economy, with the US at its center. The Saudis were not wealthy in the early 1940s because their oil production was just beginning. During World War II, Italy bombed Saudi Arabia, targeting American oil facilities, which hampered the Saudis' ability to produce oil at full capacity. In desperate need of protection, Saudi Arabia sought help from the United States. In 1945, US President Franklin Roosevelt recognized the immense global importance of oil for the coming decades. He held a crucial meeting with the King of Saudi Arabia, resulting in a pivotal deal. The United States agreed to protect Saudi Arabia from future attacks and supply them with military equipment. In return, the Saudi king agreed to sell oil primarily in US dollars. This deal significantly boosted the rise of the Middle East and cemented the US dollar's role as the dominant global currency. By the 1960s, when oil-producing countries formed OPEC, all member nations started selling oil in dollars. However, recent geopolitical events and economic practices have led to a gradual decline in confidence in the US dollar. During the Russia-Ukraine war, the US froze $300 billion of Russian assets and $7 billion of Afghan assets after the Taliban took over. This move alarmed countries like China, which feared similar actions against their $797 billion in US Treasury bonds. As a result, China and other countries started buying large amounts of gold as a hedge against the potential devaluation of their dollar reserves. The US's frequent money printing has also contributed to the declining confidence in the dollar. For example, the US printed nearly $1 trillion during the 2008 recession, $4 trillion in 2020, and about $2 trillion in 2021. This excessive money printing leads to global inflation and reduces the value of the US dollar. Consequently, countries with significant dollar reserves, like China, see their reserves value diminish. Gold, being a finite and non-printable resource, retains its value, making it an attractive option for countries looking to preserve their wealth. The limited availability of gold, enough to fit in a 23-meter cube, ensures its value remains stable. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section. In a world where traditional job security vanishes as quickly as yesterday's news, financial independence is no longer a luxury, it's a necessity. But how can we navigate this shifting landscape? What if you could learn from the best? Enter the wisdom of billionaires like Elon Musk, who defy the status quo and reveal the secrets to mastering the art of making money. When Elon Musk takes the stage, the world listens. His message? Stop relying solely on job hunting and start forging your own path. It's a bold statement, but one that resonates deeply in today's uncertain economic climate. Gone are the days when a 9-to-5 job provided security and stability. With the rise of automation and the gig economy, traditional employment is no longer a guaranteed ticket to financial freedom. Musk encourages individuals to think outside the box and explore alternative avenues for generating income. Whether it's starting a side hustle, investing in real estate, or launching a digital business, there are countless opportunities waiting to be seized. Stop looking for a job and start creating your own opportunities, Musk declares. It's a rallying cry for those who refuse to settle for mediocrity and dare to dream big. At some point in your life, you've likely pondered this very scenario. Today, nearly 30% of the global workforce is self-employed. This statistic underscores a significant trend towards independence and entrepreneurship. What's groundbreaking is the swiftness with which you can kickstart a business and connect with customers. Compared to 2 decades ago, the process of launching a business is not only speedier, but also more affordable, thanks to advancements in technology and the proliferation of digital platforms. Let's face it, no one gets rich toiling away for others. It's high time you grasp this reality once and for all. Consider the plight of an employee, earning by the hour, essentially renting out your mind for a fixed period each day. Yet, with time being finite, so are your earnings. Once your hours are spent, so too are the prospects of boosting your income. This limitation is a stark contrast to the potential for unlimited earnings that entrepreneurship offers, where your financial growth is directly tied to your efforts and ingenuity. The entrepreneurial journey, though challenging, offers rewards that far exceed those of traditional employment. It provides the freedom to innovate, the ability to make impactful decisions, and the opportunity to build something truly your own. By embracing the entrepreneurial spirit, you open doors to financial independence and personal fulfillment that conventional jobs rarely offer. In today's rapidly evolving economic landscape, the barriers to entry for starting a business have significantly diminished. Digital tools and online marketplaces have democratized entrepreneurship, making it accessible to virtually anyone with a vision and the drive to see it through. Whether it's a small online shop, a tech startup, or a freelance career, the possibilities are vast and varied. Ultimately, the choice is yours. You can continue on the well-trodden path of employment, or you can heed Musk's advice and create your own opportunities. What I propose is a shift in mindset. It's time to pivot towards charging for results. Those who truly amass wealth are those who embark on their own ventures, calling the shots and managing their time autonomously. Break free from the cycle known as the rat race and craft a flourishing enterprise. Absolutely, the timeline for profitability in business can span from months to even years, and in some cases, decades. The road to substantial profit generation is often long and winding, requiring steadfast dedication and resilience. One pivotal aspect of business that warrants understanding is that profitability isn't the sole measure of value. Even if a company isn't turning a profit in its initial stages, it still holds significant value. Why? Because value isn't just about current earnings. It's about the potential for future profitability. Consider the case of PayPal. Back in 2001, during its nascent stages, the company wasn't churning out profits. Yet, its value wasn't discounted because of this. Instead, its worth was calculated based on the anticipated profits it would generate over its lifetime. This underscores a fundamental principle. The true worth of a company lies not just in its present financial standing, but in its future potential. So, while the journey to profitability may be arduous and protracted, every step taken towards that goal contributes to building lasting value. It became evident that the lion's share of that value would stem from the anticipated profits over the ensuing decade. To ascend to the zenith of our industry, we must be primed for the enduring struggle from the outset. It's this meticulous groundwork that paves the path to profitability. Ideas, no matter how brilliant, don't materialize into success autonomously. There's nothing more detrimental than confining a potentially enriching idea to the secrecy of a box. The truth is, for an idea to endure and flourish, it must be brought to life through action. Take, for instance, the indelible legacy of Steve Jobs. Upon his return to Apple in 2001, following his ousting in 1997, Jobs embarked on a transformative mission. He orchestrated the launch of the iPod, a move that confounded many analysts and economists who dismissed it as a mere gadget cloaked in secrecy. Little did they know, Jobs harbored grander ambitions, the unveiling of the iPhone and iPad. It's a testament to the power of strategic planning and unwavering vision. Jobs didn't merely stumble upon success. He meticulously crafted a roadmap that propelled Apple to become the world's most valuable company. So, remember, behind every triumphant innovation lies a meticulous strategy and unyielding determination. The iconic lineup of portable devices stands as a testament to a crucial lesson. The most successful companies are largely fueled by the vision of their founders. Ideas aren't hoarded. They're unleashed into action with the right people to execute them. Break free from the confines of convention and seize the life you rightfully deserve. The most profound advice I've ever encountered is this: if opportunities don't knock on your door, fashion your own. So, as you watch this video, remember to affirm, I create my own opportunities. Drop your affirmation in the comments and I'll give you a little heart as acknowledgement. The facade of problems and crises that looms over our society often masks a profound truth. Amidst the abundance of possibilities in the world, economic woes persist. It's perplexing, isn't it? With so much to be done, traditional jobs seem scarce. But herein lies the crux. Unemployment isn't a testament to a dearth of work. It's a symptom of short-sightedness. Our challenge then is to refine our perspective, to sharpen our vision and unearth opportunities where others see only obstacles. Amidst the sea of problems lies a treasure trove of opportunities waiting to be discovered. Yet, many fail to recognize them, blinded by the veil of convention. Successful individuals possess a keen ability to transmute problems into opportunities. They understand that crises, far from being harbingers of doom, serve as catalysts for change and transformation. So, let us heed this clarion call, embracing challenges not as impediments, but as gateways to growth and prosperity. It's a remarkable opportunity that mustn't be squandered, a necessary evil, if you will. Those who fail to discern the silver lining within their crises are destined to endure them with heightened intensity. However, for those who recognize the opportunity nestled within the turmoil, a transformative journey awaits. Entering a realm where setbacks are mere stepping stones to success, these individuals cultivate a mindset where problems cease to exist. For every setback, they unearth a seed of advancement, transforming defeat into resounding victories. So, with every stumble, strive to rise stronger. If you've journeyed this far, affirm your commitment by commenting, I make money solving problems. Your comment will serve as a testament to your dedication and perseverance. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section. Let's talk about a financial powerhouse, Singapore, and how it manages its massive wealth. Singapore's foreign reserves are among the world's largest relative to its GDP. In fact, according to GIC, Singapore's official sovereign wealth fund, they rank third highest globally. But you might have noticed that these reserves have dipped recently. So what's going on? Well, it all started with the COVID-19 pandemic. The pandemic hit the global economy hard, and Singapore was no exception. To stabilize the economy and support businesses and individuals, the Singaporean government had no choice but to dip into its reserves. During the pandemic, economic activities were severely disrupted, leading to a sharp contraction in Singapore's GDP. The government had to act fast. They rolled out various fiscal stimulus measures to provide immediate relief to those affected by the crisis. One of the key strategies was to tap into the nation's substantial foreign reserves. So, how much foreign reserves does Singapore really have? Let's break it down. Singapore's reserves are managed by three key entities: the Monetary Authority of Singapore, MAS, GIC Private Limited, and Temasek Holdings. The Monetary Authority of Singapore, MAS, is the central bank and financial regulatory authority. It manages the official foreign reserves to ensure monetary stability and safeguard against economic shocks. Think of MAS as the first line of defence, always ready to step in during turbulent times. Then there's GIC Private Limited. Established in 1981, GIC is tasked with managing Singapore's foreign investments. Its mission is to secure a good long-term return on the nation's reserves. GIC invests in a diverse range of assets globally, including equities, bonds, real estate, and private equity. This diversification helps spread risk and capitalise on various market opportunities. Finally, we have Temasek Holdings. Unlike GIC, Temasek operates more like an investment company. Established in 1974, it owns and manages a portfolio of investments across various sectors. Temasek focuses on delivering sustainable returns over the long term. It has stakes in many major Singaporean companies and strategic investments worldwide. Together, MAS, GIC and Temasek form the backbone of Singapore's financial management. They ensure the country remains financially robust and can weather economic storms. Now, why does Singapore maintain such large reserves? The answer lies in the country's unique position as a small, open economy highly dependent on international trade. Large reserves provide a cushion against external shocks, such as sudden capital outflows or global financial crises. They also instill confidence among international investors and credit rating agencies, contributing to Singapore's economic stability. But managing these reserves isn't just about safeguarding wealth, it's also about growing it. By investing wisely through GIC and Temasek, Singapore ensures that its reserves generate returns that can be used for future generations. This forward-thinking approach is key to Singapore's economic strategy. So, when the COVID-19 pandemic struck, Singapore was prepared. The government's decision to use the reserves was strategic and necessary. It allowed the country to navigate the crisis without compromising its financial health. This is a testament to Singapore's robust fiscal policies and disciplined approach to financial management. The pandemic wreaked havoc on economies worldwide, and Singapore was no exception. To stabilise the economy and support businesses and individuals, the Singaporean government had to draw from its reserves. This move was crucial to counter the significant disruptions in economic activities that led to a sharp contraction in Singapore's GDP. Before we delve deeper into how much they have, let's first understand what a foreign reserve is and where Singapore gets it. Foreign reserves are assets held by a country's central bank or monetary authority, usually in various currencies. These assets can include money, bonds, treasury bills, gold, and other financial instruments. They are essential for meeting international financial obligations, such as importing goods, services, and repaying external debt. Foreign reserves also serve as a tool for central banks to ensure stability in their own currency by intervening in foreign exchange markets when necessary. Singapore's foreign reserves are accumulated through various means, such as trade surpluses and the acquisition of US dollars. Thanks to its strong trade sector and prudent fiscal policies, Singapore has built up significant reserves over the years. So, how do these reserves benefit Singapore? Large reserves provide a cushion against external shocks, such as sudden capital outflows or global financial crises. They also instill confidence among international investors and credit rating agencies, contributing to Singapore's economic stability. But it's not just about safeguarding wealth, it's about growing it. Through GIC and Temasek, Singapore ensures that its reserves generate returns that can be used for future generations. This forward-thinking approach is key to Singapore's economic strategy. Singapore's foreign reserves rank among the largest globally, particularly when measured against its GDP. According to the official Sovereign Wealth Fund, GIC Singapore is third in the world in terms of foreign reserves. However, the COVID-19 pandemic brought about a significant challenge, leading to a recent decline in these reserves. So, how does Singapore manage its massive wealth, and why did they have to dip into their reserves during the pandemic? Singapore's foreign reserves are accumulated through various means, primarily trade surpluses and the acquisition of US dollars. Singapore is known for its robust export industry, consistently exporting more than it imports. This results in a net inflow of foreign currencies. For instance, in 2023, Singapore exported a total of $638 billion and only imported $567 billion, maintaining a positive trade surplus from 2019 to 2023. Another source of foreign reserves is through the acquisition of US dollars in exchange for Singaporean dollars. This action helps control the strengthening of the Singapore dollar's exchange rate. Since the early 1980s, the Monetary Authority of Singapore, MAS, has focused its monetary policy on maintaining the exchange rate within a specific target band. The pressure to appreciate the Singapore dollar stems from supply and demand dynamics in fund flows. That's it for today. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section.